CF benchmarks.
I think a lot of the investor base, if their only option was unstaked ETH, they know how volatile the asset is and the return profile of it. And if they like the conviction of that asset, staking or not staking isn't going to break that investment case. It's a small part of it from a volatility perspective. But if you could have the alternative and you were comfortable with the risks of the alternative, I think a lot of people have just had the view of why would I want to own ETH plus 0% when I can get ETH plus 2%? And I think that's a very simple generalization, but that's how I've heard investors speak about it. I've heard wealth advisors speak about it. I've heard hedge funds ask about it that way. And so it's really across the spectrum that we've seen client interest and demand through time.
You're listening to CFB Talks Digital Assets, the home of informed conversation about crypto for institutions building the future of finance, brought to you by CF Benchmarks, the world's largest crypto index provider. Hey everybody, thank you very much for joining us for another episode of CFB Talks Digital Assets. My name is Ken O'Delaga, I'm Head of Content, and as usual, I'm joined by my colleagues, Gabe Selby, Head of Research, and Mark Pilipchuk, who is our Research Analyst. And today we are joined by Matt Kunke, Digital Assets Product Strategist at BlackRock. Matt, we are so pleased that you're taking time out of your schedule to join us today.
Yeah, thanks for having me, Ken. Excited to be here.
Brilliant. And the reason why Matt is here is should be obvious. BlackRock is one of CF Benchmarks' largest clients, the manager of the IBIT Bitcoin ETF, BlackRock Bitcoin ETF Trust. That's the ticker IBIT, which is, of course, the largest Bitcoin ETF in the world by assets under management. And CF Benchmarks provides the benchmark index, Bernie, as it's called, or the CME CF Bitcoin reference rate New York variant for this index. And as well, BlackRock's ETHA, which is, of course, BlackRock's Ether ETF, is also benched to one of our products. And in recent weeks, of course, BlackRock has launched its first staking ETF, ticker ETHB, and that's basically rapidly becoming one of the largest Ether staking ETFs in the world, again, by assets under management. So Matt, just to get things going, it's been around for, I think, about 6 weeks now in the market. What is top of mind for you related to that?
Yeah, I mean, it's so we're just under 4 weeks now, so a little under a month. It's been another really successful launch, and I think if I was to sort of rank this, I would say a top-quintile launch relative to expectations. I think there was always a little bit of pause with respect to just launching a new product into markets that have been moving sideways and have been quite challenged for a little while in the crypto market. But we've seen really, really strong momentum. It's about a $450 million product. I think just generally overall, though, it's a preferred implementation for Ethereum for a lot of investors, and an implementation that was not available for those who were familiar with investing through the ETF wrapper, or the ETP wrapper, I should say, more specifically, to not get us in trouble.
Sure.
Because they're technically 1933 Act trusts rather than 1940 Act ETFs. But yeah, I mean, I think at the end of the day, this is a wrapped product that has Ether, the underlying asset of Ethereum, is the underlying, fully physical, no leverage, no lending, nothing exotic or funky there. And instead, though, where Ethereum is a proof of stake blockchain, the original products that were launched in the summer of 2024, like our ETHA product, the first generation of these products in the US, they weren't allowed to stake the underlying asset. And so what that means is they weren't allowed to participate in the network's consensus and move the blockchain forward. But that also comes with the headwind of not receiving the staking yields. And so that's something we've heard from clients relatively frequently, that they like the asset, they want to have a staked version of it, and then they'd reevaluate in the ETF structure or the ETP structure. And so that is now more feasible. That is what launched just about a month ago. And so now it's really another Ethereum product. Most of the underlying ETH is staked, so participating in consensus, earning the rewards, and then that would be paid out monthly as a distribution of staking rewards in US dollars to investors holding the product. And so I think the last thing I just want to highlight quickly is, like, we are a bit unique relative to peers here. And then we took the approach of being very client-centric and just giving clients choice. Because while we think most investors do prefer a staked product, we have heard from some of our clients they don't want to be forced into it, right? They don't want to have their existing exposure that they've underwritten go from unstaked to staked. And so that's why we've taken this approach of launching a new product in ETHB that is the staked product and keeping our existing product in ETHA, which is an unstaked ETH product.
You mentioned obviously the solid first few weeks of inflows, assets gathered to now stand at 450 million. Clearly, this is, as I said, solid. This is an excellent outcome. What I'm interested in is for you to maybe talk about the fact of those assets gathered relative to where we are in the market side, the market cycle, not just for obviously Ether, Bitcoin specifically, particularly as well, and the altcoins in general, and what that may be telling us. Do you take the deduction as well? Do you take from that these volumes of these assets that you've gathered that demand is superseding or outpacing any lower sentiment or weakened sentiment that we may be experiencing due to the market conditions?
Yeah, I think there's some element of both sides to that. Like some element of this certainly is folks swapping from an unstaked version to a staked version. There's definitely also net new buyers as well. And so I think it's hard to like very perfectly delineate that. But I would say that I generally agree with that sentiment, and that I've seen a pretty stark divide. And speaking to some of my crypto friend groups from crypto native firms, and I would say sentiment there is certainly weaker than sentiment in the TradFi world that is getting more and more exposed to crypto via ETPs. I think a large part of that was the leverage flush in October of last year that really impacted those trading levered perpetual futures on crypto offshore exchanges. And then I go speak to advisors in the Midwest or advisors all over the country, and they're, in many cases, they've never had the ability to access it. You just had a wave of approvals. On the Bitcoin side, ETH's a little bit behind there. And they're looking to get off zero in their portfolios generally. And so it is a pretty polarizing divide between what you see from folks in the crypto ecosystem versus the traditional world today. So I'm pretty optimistic.
Well, I think there's a obvious question that maybe the listeners want answered. And we have ETHA, which of course is the unstaked product, and we have ETHB, which is the staked product. Could you walk us through, like, high level, what was kind of the logic of doing a new product for ETHB, the staking product, versus just enabling staking for ETHA?
Yeah, so I mean, I think it is really just that element of choice. It wasn't something that 100% of investors said we all want staking. Like there's certainly elements of complexity. At the end of the day, like you are receiving rewards for bearing some risk. We think that risk can be mitigated to a large degree, but it is a different risk return profile slightly. And then some of the platforms, right? If they're trying to get familiar with Ethereum and underwriting the investment case for Ethereum, and then you throw in this like perhaps ominous concept of staking that they're entirely unfamiliar with, that's another hurdle. And so giving investors choice to meet them where they're at with the products they want and not forcing them into a new situation that they didn't opt into initially was our primary driver and motivator. And there can be elements too. Like we certainly don't give tax advice. I don't want to harp on tax too much, but there's an element of uncertainty around UBTI and things like that if you hold this in a tax exempt account, you might prefer to stay in ETHA. You might prefer to have an unstaked version. And so all that's to say, it wasn't universal that 100% of the investors in ETHA or ETHA would have preferred a staked version. And so we took the approach of giving them the choice.
Yeah, and then when you're underwriting ETHB versus ETHA, when you have on the risk side, when you're thinking about staking, the biggest one that comes to mind is the risk of slashing. Could you just kind of talk a little bit about that and what's done to mitigate that risk?
Yeah. I wonder if like it's even helpful to just like start what's happening here? Like what is staking? Staking, like all these blockchains, right? They're decentralized transaction ledgers. And like you need to, in the absence of a controlling party, determine who in this decentralized setup is going to be able to propose the next block of transactions and progress these chains of transactions forward. And so this is like not an ETH specific thing. This is universal to all blockchains. Like most notably Bitcoin, right? Using proof of work, where they're using electricity to secure the blockchain and determine who gets to propose the next block. I would say in building that understanding, I think like one mental model I always like to frame consensus mechanisms through is like they typically follow the flow of requiring you to post something of value or expend something of value as an incentive to follow protocol rules, or a disincentive to deviate from the protocol rules. And so in the form of Bitcoin, like that is spending a lot of electricity. And then if you were to propose an invalid block, you just paid a lot of money on electricity to post a block that's going to get rejected by the network, and all that money's gone. So you're entirely disincentivized from doing that. In the case of Ethereum, it's a little bit of a different model. Instead of spending something explicitly like electricity in dollars, you're actually posting more of like a collateralized bond is one way of framing it. You take ETH, you hold it in effectively an escrow account, and that's your incentive to follow the protocol rules, to post valid blocks, to attest to your view of the chain, to not do malicious behaviors in the decentralized network. And if you do, that ETH can be penalized if you're offline, or if you do things that are actually malicious, which is slashing. And you can actually lose rewards, and you can lose your bond that you posted. And so that's really the intrinsic motivator for you to follow the protocol rules. You'll be rewarded with income or new ETH generated for participating and being online and performant. But that's the risk you take. If like that's what can happen if you were to behave maliciously.
That's a top-notch exposition, Matt. Probably the best I've heard for quite a while. So brilliant. Clearly, that's what you do, right?
To the extent that you can, I guess let's start from an operational standpoint, how the validators are actually managed, and then we'll kind of go from there.
Yeah. So just building the intrusion a little bit further, what does it take to be a validator? Like these are just computers running Ethereum software. And so there's different clients you can run. And that software is like where you're hearing the mempool and like listening for transactions and validating transactions. And so in terms of how we actually do that, we're not the operator of the validator infrastructure. Like that is a requirement of the ETP, is to use third parties. You can't do it internally. And so we are using 3 different staking service providers today. And that's like a very, that was a very deliberate risk decision to use multiple, because of how Ethereum penalizes. Effectively, the goal is for Ethereum, it's to penalize it's not to penalize poor performance that isn't a risk to the network. It's to, like, you're going to pay a small penalty if you're offline and you're not contributing to the chain security, but it's really designed to like very starkly and sharply penalize anything that looks malicious. And so that in Ethereum land is like what's called a correlated slashing. It's when a lot of people get slashed at the same time, and that actually looks more like it could be an attack on the network. And so that's where having multiple different operators is actually super powerful from a risk perspective, because if somebody was to have an issue where they got slashed or anything like that, they're generally very idiosyncratic. And so running multiple different ones, you're unlikely to have all of them slashed at the same time. And that's really how you can minimize the risk surface that you're exposing your ETH to. I do think it's important to kind of flag too, though, that correlated slashings have never happened. This is like very much a left tail theoretical that hasn't happened in practice. Even just a generic slashing. And so like what even is this? That's like you as a validator. It's if I was to propose 2 separate blocks and trying to kind of trick the chain or confuse the chain, or I was to attest to saying, here's my view of the tip of the chain, and I was to say 2 different things at the same time, those are attributable faults. That's something that would get you slashed. But even if that happened to you in isolation, it'd be a pretty modest hit. Like, so I think if you were to look at all validators that have ever existed, it's something like 0.03% have ever been slashed. And then of the amount lost of those slashed validators, it's actually the case that the largest loss has only ever been about 1% of their stake. So like very minimal in practice. I think it's though the tail risk of like that concept that I was alluding to earlier, correlated slashing, where in theory, all the money can be lost. It's never happened before. But you want to take all the steps to sort of ensure as much as possible that like you've taken all the precautions and steps necessary to mitigate an event like that occurring in the future.
And to elucidate another key aspect of the validator process, the 32 ETH, which I believe is the minimum or some sort of standardized form of amount of ETH to be staked? How does that work? Why is that? I mean, we've all seen the history. We know why it's there, but it'd be great to hear you sort of elucidate that, Matt, in your own words, obviously.
Yeah, I mean, I think there's a lot of technical reasons for 32 historically. There's a lot of messaging overhead if you were doing messages across all these validators. Because again, this is a decentralized network of all these parties signing keys. There's aggregation schemes on the background. But if you had, let's say, validators are 1 ETH, it's really large messaging overhead. All of this is going to bloat the hardware requirements of nodes. If you were to say it's a 1 ETH minimum now, like it's going to be much harder to run Ethereum client software on an at-home computer, for example. And you might need to have a server and more infrastructure, which is a centralization vector in itself. And so that's definitely part of the intuition, at least historically. Now it's evolved, though, post Pectra, which is a recent upgrade, where you can have much larger balances. So you can have validator balances up to 2048 ETH. And so that can also help reduce that messaging overhead, right? If you run 10 validators of 32 ETH, you can now concentrate that into a single 320 ETH validator, which is going to also contribute to reducing that messaging overhead.
Can you walk us through a little bit about like the decision to come up with like a percentage of the fund that should be staked? Like I think right now, according to online, you're targeting between like 60 to 90%. Is that right for the fund? How did you come up with those ranges?
Yeah, I mean, we have 70 to 95%, right? Like at the end of the day, I mean, we had, you can look at historical flows for ETH, you can look at our ETHA product, you can look at historical flows for other ETPs, you can look at things like the volatility of the space and just try to come to a sense or term of understanding around what could be normal in terms of redemptions, right? About how many people could want their ETH back at a given point in time. And so this kind of gets into the point of queues, which we haven't really spoken to at this point, but like ETH, like staking ETH fundamentally, it's a trade-off between liquidity, like you're locking your ETH in a contract in exchange for rewards. And ETPs by their nature are daily liquidity vehicles. And the way Ethereum, the protocol works is like to secure the consensus of Ethereum, they rate limit how much new stake can come on or come off at a given point in time. And so that rate limiting, right, that is done intentionally to not allow sorts of consensus attacks. But that has a challenge because that basically means if we're rate limiting this to have a fixed amount of ETH come off at a particular point in time, you can never forecast in the future how long it's going to take you to get your ETH out. It's in this locked contract you can think of. And once I signal an exit saying, hey, I want to unstake, from that point on, you can determine exactly where you are and how long it'll take you to get out. But if you're saying I'm going to exit in a week and you have some big risk event where all these other validators exit before you in that time, you're going to be behind all of them in the queue, and that can balloon to weeks or even months. And so that's what you're really managing for, of like, how can we minimize the chance that we're going to have a delayed settlement on a primary market AP redemption because all of our liquid unstaked ETH is already paid out to folks trying to redeem, and now we're stuck with only staked ETH. And so that's really what you're managing. You have a bunch of risk teams involved. I'm trying to figure that out. I would put one important caveat here. This isn't to try to make projections or say, what can or can't happen. But I think a really indicative example of this is you can look at like Lido's staked ETH product. Their liquid staking token. It's just a token that is a claim on underlying staked ETH. And so you can kind of, in a way, think of it like the ETF, except they have zero staked ETH buffer, right? Or sorry, zero unstaked ETH buffer. They're just fully staked. But because once you trigger an exit, you know exactly how long your duration is, that's actually a pretty easy thing to hedge. And so you would anticipate if all the liquidity's dried up, the product would trade at a discount, whether it's ETP or liquid staking token. But because it's perfectly hedgeable in terms of the duration and the ETH price risk, you would think it should be relatively tame. Because you could always just buy back the discounted ETP, you could buy back the discounted Lido staked ETH token, and you could hedge out the ETH price risk for 2 weeks, a month, whatever your timeline is. And so from that perspective, you'd think it should be some variation of the risk-free rate with some spread on top of that. But you wouldn't expect this to go and start trading generally at like a 10% discount because there's no liquidity. It just means there's no liquidity for this entirely knowable period of time in a perfectly hedgeable scenario. And so you actually look at like even like Lido staked ETH tokens, since withdrawals were possible where you could actually get liquidity on staked ETH, because for the first several years of Ethereum's history, there was no liquidity at all. You couldn't withdraw staked ETH. You'd actually see that like the largest DPEG it's had is like less than 50 basis points. And so you're not going to see, I don't expect you to see these 10, 15, 20% discounts. It's going to be relatively measured because you're going to have very sophisticated market actors who are going to come in, buy the discounted token, hedge out the ETH exposure, and clip that spread to the extent it diverges too much.
So you're saying that because there's liquid staked ETH, it's almost like this ecosystem has evolved now to where it's mitigating some of this build up, and what we're talking about is the queue is what we've heard in the being reported in news if you've followed this, where the queue can get backed up because there is that limit that you were talking about. What's the queue looking like today? I mean, last time I checked, it looked like things were backed up almost like a freeway here in Southern California, just right through the middle of rush hour, heading into the city. But heading out of the city, it hasn't been too bad, right?
Yeah, that's exactly right. It's a great analogy. Right now, the entry queue is quite long. It's about 50 days. So that basically means if I want to start staking, I am going to have to wait. I'm going to have to deposit the ETH and wait about 50 days before I'm actually actively attesting to my view of the chain and proposing blocks and actually getting rewarded. But then the exit queue right now is very slim, or it's very modest, right? It's basically zero. It's like less than 1 day, and that's really the risk from an ETP perspective, right? Of the liquidity side, and that's why you have that unstaked buffer. But the unstaked buffer is, if you could guarantee your exit queue would stay at that, you'd probably manage it very close to 100%. But you can't guarantee that, and that's why you do have that unstaked buffer. And then on the entry side, you can almost think of that as just a delay to receiving rewards.
Yeah, I wanted to emphasize actually, Matt, because this is very important for clients, and I'm sure that you'd love to sort of underscore this as well, that you mentioned that the staked amount, the policy, something like 70 to 90%, I think that you mentioned. Obviously, that can vary over time depending on market conditions. You've extrapolated very, very eloquently as to why these policies, these terms are in place, reinforced by a whole host of risk management sort of measures as well, and risk management team. But in fact, a lot of these precautions, although they are there for a reason, your view is that it would take a very, very extreme set of circumstances for most of the most dire situations to come to reality, and therefore it's obviously a reassurance for investors. I think that's what I'm getting from you.
Yeah, I would agree with that. Like our liquid ETH buffer is designed to be sufficient to fulfill redemptions in normal environments. In abnormal environments, when that gets depleted, it's still a very hedgeable trade that sophisticated actors, we think, will hedge it and keep the premiums the discount relatively in line at some variation of the risk-free rate plus the spread. But we don't anticipate it should be it should have the ability to really fall off too meaningfully because of how hedgeable it is. It's not like some illiquid asset that has no ability to be hedged out and you're hoping for the best a month later.
No, we're well past that stage with Ether. So let's talk about what, broadly speaking, a staked Ether product like ETHB, what it solves, what it addresses, the need in the market. We're keen to hear about the client side. If you could sort of elaborate about maybe the etiology or the sort of genesis of ETHB, where was the impetus coming from, and how did we come to this stage, basically?
Like when ETHA launched, there wasn't clear guidance on how you could do staking in a grantor trust. There is now come out with guidance for how you can do this in a safe fashion. And so I think it just became more feasible from a risk perspective, from a regulatory perspective, to begin staking. And I think it's been one of those things that if you were to look in other jurisdictions, other regions, you typically see staked products have been superior from an AUM perspective, from a client demand perspective, from an interest perspective. That's true in Canada. That's true in Europe. And so I think it's always been something that we would want to do. And it's something that we've heard. I can't generalize it to a single client type, because I would say across every client type, I hear every once in a while, reach out to them, like, let's talk about IBIT. We don't want to talk about ETHA today, but give us a call if you ever have a staked ETH version. And so now we're having those conversations that for the folks that are limited to investing through the ETP wrapper and don't have a presence in the crypto native world of buying coins directly, they haven't been able to buy a staked ETH version. And so that's how I describe it, where most investors, like, if you're like, the overwhelming volatility of this trade is still going to be based off the price of ETH. Like, if you think about after a liquid ETH buffer, we would think this is, at least today, off of today's staking market conditions. And again, it depends on performance, depends on, like, you can have penalties and there are risks. It's not a guaranteed thing, but like in a general market environment, based off the dynamics of the network today, that's something like a ETH or the return of ETH plus like 2% per year that's being distributed each month in cash. And so I think a lot of the investor base, if their only option was unstaked ETH, they know how volatile the asset is and the return profile of it. And if they like the conviction of that asset, staking or not staking isn't going to break that investment case. It's a small part of it from a volatility perspective. But if you could have the alternative and you were comfortable with the risks of the alternative, I think a lot of people have just had the view of, why would I want to own ETH plus 0% when I can get ETH plus 2%? And I think that's a very simple generalization, but that's how I've heard investors speak about it. I've heard wealth advisors speak about it. I've heard hedge funds ask about it that way. And so it's really across the spectrum that we've seen client interest and demand through time.
Brilliant. Thank you.
Yeah, I think for me, Ethereum, in terms of its investment thesis, is kind of a bet on technology and the blockchain. And I would be curious to get your perspective, since you're someone who's in front of clients more frequently. How is that pitch resonating with the advisor group? Are they seeing that same thesis? Or how do you even pitch a financial advisor in the Midwest who just doesn't even understand what a blockchain is? How do you sell them on Ethereum and why this is important?
Yeah, I generally frame it as two-pronged. Like, this is a Bitcoin versus ETH story of, the scope is generally limited to those two assets. So you don't have too many people asking about the long tail of assets. And Bitcoin being like the very clear, non-sovereign, doesn't change very much, scarce asset that's able to make these like really long-term assurances about its scarcity. And even though like their issuance schedule today is close to identical actually in how much new Bitcoin's being issued versus how much new ETH's being issued, ETH has to hard fork twice a year. And so I think there's that element of it, like the forced change of it. I think it leaves a different sentiment in the investor's mind, right? If your only goal is being non-sovereign money, you don't have to also compete on other things. And that's like right. Even if you said ETH has really good non-sovereign properties from its issuance, if it's supposed to be a technology platform for stablecoins and all these other things, and it fails to meet those objectives, it's not going to be valued just off its monetary properties. And so that makes it a harder angle. And that's how I agree with you. I generally frame it that way. Like, Bitcoin's like the very clear non-sovereign money. Ethereum's the most secure, resilient, smart contract blockchain. It's been around since 2015 with 100% liveness. Like, you've never had an Ethereum blockchain halt or fail to produce blocks. And if you think about institutional blockchain use cases, things like stable coins and tokenizing US dollars and fiat currency, or whether that's now moving into the world of tokenizing securities, I think institutions are going to prefer the most secure, the most Lindy, the most robust platform. And that's kind of the story of Ethereum. It's not to say Ethereum's the only platform doing that, but I think it's the clear first mover. It's a clear front runner from a size perspective, from a security perspective. And so we frame it often as just a bet on that theme, and a bet that the Ethereum ecosystem is going to be the leading ecosystem in the future for these institutional use cases.
So Matt, there's a lot of talk, obviously, in this world about staking yields and, the yield being this 1 week and obviously that another week. But I think there's definitely scope for being a little bit clearer for this for, uninformed people or people who are a little bit unclear about exactly what it means and how it works. So please talk about staking yields. How does that staking yield actually get to the end investor of ETHB?
Yeah, so I think ETH staking yields. It's just important to kind of say what they are. Like, there's kind of 2 points to this. There's the elements, and this is the same thing as Bitcoin, right? Like, where you spend electricity to get paid new Bitcoin issuance. It's the exact same thing with ETH. Like, there is ETH issuance through the staking process that's going to these validators, and that's a relatively small number, less than 1% per year. But that's the majority of the staking yield today. So if 1%, let's just say 1%, just even though it's less, is being issued, but only 30% of the network is staked, that's actually going to look like a 3% yield from that validator's perspective. I'm just using illustrative examples there, but that's kind of the rough ballpark. There's also an element of transaction fees, but I would note this is more volatile. It's based on market conditions. It's a smaller percentage of the rewards, and so generally less relevant. And it's only a certain subset of transaction fees too. But that is like there's a market demand based element too, of if you want to include a transaction fast, paying a priority fee that would end up going to the validator, which contributes to the ETH staking rate, particularly in more volatile market environments. In terms of the issuance, though, I think one point is like directionally where this is and where it's going. The driver of it, it's really one variable that describes how ETH is issued, and it's just the number of validators validating. Like, you can think of the security and incentive mechanism being, we're going to pay a lot of money when there's very few validators. Like, validators are ultimately the thing that give the network security. And so like the protocol is designed to pay pretty high fees to validators in the early days to incentivize more security. But then also, as you get a lot more validators, the incremental N plus one validator is a lot less important. And so it kind of flatlines. And so it continues, like, rewards, the total amount of ETH issued grows up, but it goes up at a diminishing marginal rate relative to new validators. So what that actually means, though, in reward space and APY space, rewards go down through time, or the issuance component of rewards go down through time as a function of the validator count. And so we've seen that basically be a directional downtrend of rewards. But I would kind of note that point of, we have a very large validator account. And so if you think about that curve, it's pretty sticky around where it is today. It's going to continue to go down, quite frankly, but you're not going to see it go from 2.75% to 2% overnight. It's this very, very gradual decline. And then there's even a lower bound on that. Like, even if you said 100% of the network is staked, just to give you some proximity, like, it wouldn't fall beneath like 1.25%. I believe is the exact number, even if you had everyone staked. You're not anywhere close to that. So you'd probably expect a very gradual decline lower from a rewards perspective.
So with the Pectra upgrade, they increased the balance amount from 32 ETH to 2048, right? 2048 ETH, which in theory consolidates validators. Did that have an impact at all on staking yields? Or was it pretty flat and non-material?
Yeah, I mean, like, I shouldn't say that. I shouldn't say validators as being the sole factor. It's more like the amount of ETH. So like, yeah, it's the amount of ETH more than the validator. So if you're saying like 2048 validator, it shouldn't have moved it any meaningfully, unless you had just thought Pectra was causing more people to stake. I would say it's getting moved more meaningfully by things like some of the digital asset treasury companies. Certainly the ETPs being a large pool of capital that was unstaked historically, and now some of it will be staked. Those are contributors to that entry queue that we discussed earlier, and will push the staking yield down. But it's a very gradual decline is what I'd want to flag. You're not going to see any sharp movements in the staking yield given how many validators there are already today.
No, that's interesting.
Yeah, I guess in terms of just outlook for the products, what else is next year? Because now that we have the staking, the actual yield, there's all sorts of strategies you can start to layer on top of that. We've seen basis strategies with Solana and their staked ETFs. It's likely we'll probably see it on ETH, and then maybe covered call or other ways to earn income in the future. Do you think that's likely?
Yeah. So on basis, like, I would just clarify that, like, that's typically hedge funds or other investors buying either spot or an ETP and selling a futures contract, just as demand for leverage often causes these futures contracts to trade at a slight premium. And so less so that there's going to be ETPs that do this strategy, and more so that the ETPs might be an instrument use in those strategies. And that's definitely true, particularly with the hedge funds. We've seen that already with our IBIT product. We've seen that with our ETHA product. I think a large number of those hedge funds that have traded that exposure through ETHA in the past probably will use ETHB in the future, because it's just another way to get a higher yield. And that's ultimately what that trade is doing. And so I wouldn't expect to see that wrapped in an ETP vehicle, though. I do think modulated exposure, like I would say very clearly, like Bitcoin and Ethereum are the two assets clients are asking about most. It's certainly Bitcoin is the majority skew of that, just given the size differential and understanding, and frankly, technical simplicity relative to ETH. But that's really like, if you say, 10 conversations are about Bitcoin, maybe 20% of those are now more broadly talking about Bitcoin, ETH, tokenization, stable coins. I mean, it's probably more like 50 realistically now after Genius was approved, but it's still very few that go further into these other longer tail assets. And so I do think our focus is going to continue to be on what are clients asking about, and then what kind of unique ways can you offer, maybe modulated risk exposures on that, or just tweaked risk exposures, not just necessarily vanilla. I can't really go into the details because we have outstanding filing. We have an outstanding filing for Bitcoin premium product, exactly kind of as you allude to. And I do think ETH staking similar to that too. It's obviously very different, and that staking is very different than selling options, but like it's a modulated risk exposure. It's a differing risk profile on the same asset. And so I think you're going to continue to see that sort of play out.
So you talked about the sort of tenor of the kinds of conversations that you're having with clients, advisors, and so forth. What I'm curious about, and this is probably, definitely an uninformed question, but I think it might be interesting to our listeners and viewers. What is your sense of the split, if there is one, of interested advisors or institutional clients in obviously, as you mentioned, the key products, Bitcoin and Ether ETFs? Are you seeing the pattern of basically allocating to both predominating, or is there still a bias for particularly Bitcoin, I guess? Well, what's your view of that?
Yeah, there's definitely a bias to Bitcoin, but I wouldn't say it's insurmountable and that like it's universal. I think all these products, they're actually like really unique compared to the normal trajectory, like the normal client trajectory of like an asset class coming through like the institutional world to the wealth world, and then now trying to democratize access and bring institutional products to direct investors. Like crypto is very fundamentally like a people centric. It's like it's the antithesis of that to a degree, right? Where it started by the individuals on cryptography mailing lists, and then direct investors, and then moving slowly towards wealth, and then into institutional. And you saw that with IBIT's 13Fs. Like you could see so little of the AUM was explained in the early 13Fs because there was so much direct investors, and they don't file 13Fs. And so really that was fascinating to watch that tick up and up and up through time, where now you've seen immense growth on the wealth side and the institutional side. And as I was alluding to at the beginning, like even just at the end of last year is when it really started picking up from a wirehouse perspective, seeing some of the big banks like Morgan Stanley and others publicly start to approve these products, where historically, even though smaller RIAs could allocate to these products, some of the biggest wirehouses in the industry still inhibited their investors from accessing it. And so I would say ETH is on that same trajectory. It's further away on that trajectory. It's smaller in nature, but we are seeing it. We're having those same conversations about platform approvals with those wirehouses, those private banks on ETH today. It's fewer in magnitude, but I actually am optimistic ETH over the next couple of months may look like, from an approval perspective, where IBIT, looked 9 months ago.
Wow. Great to know. Great to know. Matt, you have basically just a barrage of insights and information here. We so appreciate that. Basically, this is a multi-layered world that could be forbiddingly complex, but you've made it sound so transparent and lucid, and we really appreciate that. Thanks a lot.
Thanks so much for having me. It's fun.
Yeah, thanks, Matt.
All right. So that was Matt Kunke, digital asset strategist at BlackRock. We hope that you got as much out of that scintillating conversation as we did. If you like the conversation, then we now have around about 55, 56 episodes of CFB Talks Digital Assets out there. Navigate to your favorite podcast platform to listen to those. cfbenchmarks.com is where you need to go for the rest of our content. And after you've absorbed all of that, we'll see you again for another episode of CFB Talks Digital Assets. Thanks for joining us.
Thank you for listening to CFB Talks Digital Assets. This recording is for informational purposes only and should not be considered investment advice.
This recording is not intended to persuade or incite you to buy or sell any financial products noted within, including but not limited to exchange-traded funds, mutual funds, equities, other instruments that reference any index provided by CF Benchmarks Limited, or crypto assets. Any commentary, interviews, and discussions are opinions only and should not be considered a personalized recommendation. Please contact your financial advisor or professional before making an investment decision. Note, some of the underlying instruments cited within this recording may be restricted to certain customer categories in certain jurisdictions.